Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Hello, my name is Lisa Simpson, and I'm excited to welcome you to this special edition of the AICPA Town Hall. We're recording this on Monday, July 14th. We have a very packed agenda for you today, as you can imagine. So let me give you a little bit of insight into how we're going to run today. We're going to do a very fast DC update with our Executive Vice President of Advocacy, Mark Peterson. If you were on our town hall last Thursday, you're going to see a little bit of a repeat, but I promise you we've got new information and some good updates for you. We're going to spend the bulk of our time today with Melanie Lorenzen and Jan Lewis, who are going to review the tax provisions in detail. So a lot of great change information and slides that you're going to want to capture by downloading the slide deck for today. We're also going to hit on those effective dates that a lot of you asked about last week. Then we're going to move into the implementation phase. Melanie's going to walk us through what the IRS is going to start doing now that the law has been signed. And then if time permits, I'm going to bring Jan back and we'll have a quick conversation about what she's going to be talking with her clients about next. And then of course, we'll end with open forum. So with that, let's get started. And Mark Peterson is in our DC office. Thanks for joining us today.
Great
I thought
to be
we'd
here,
start
Lisa.
with some more good news.
Yes, some great news. So actually on Friday, the Senate passed disaster relief legislation that we've been working on for years, major grassroots effort that's gone on for years. Our partners in the state societies have helped as well. This was an issue we took to Capitol Hill in May when we had DC Council here. But basically what it allows is a disaster to be declared when the governor decides it's a disaster versus having to be at the federal level and go through FEMA, which allows the IRS to extend deadlines more quickly. It gives certainty and clarity more quickly during really, really tough times. So this is great news and another win for the profession and for taxpayers.
Absolutely. Thanks. And thanks for all your hard work on that and for all of the folks who've been advocating for this. So last week you talked briefly about some of our legislative wins. So let's hit those again for those who weren't able to join us last week.
No, absolutely. And these are a set of issues that we've actually been working on for quite some time. As a matter of fact, most of these issues were included in previous bipartisan legislation. You may recall, Lisa, we talked about the Wyden-Smith Act over the last few years, prior to moving into reconciliation. So although there's strong feelings about H.R. 1, the large bill, these provisions actually were contained in many of them in bipartisan legislation. The pass-through entity tax we're going to talk about a little bit, but R&E, 163J, the 529 accounts really helpful for the CPA pipeline, trying to help with the cost of post-secondary credentials.
And we've got an extra page, so that's always good.
We do. It just keeps going, doesn't it? 199A. Again, extremely helpful. The contingency fees, which were initially included, but then withdrawn to actually reconcile with AICPA ethics. So again, a lot of strong feelings about the bill, but we really focus on the best outcome for the profession. And these are the issues that we really worked hard on.
Yeah, that's great. And then the PTAT that you talked about a little bit earlier, you want to give us a little bit more intel?
No, absolutely. And we talked about this on Thursday too, but nothing happens by accident, Lisa. So there was a lot of work that went in this. Right now we can enjoy deducting state income tax in 36 states. And for a while there was in the House version, it was taken away from SSTPs. And then in the Senate version, again, that was adjusted, but we're not going to be made whole, or at least be status quo. Ultimately, we're talking billions of dollars that were saved by continuing to allow this deduction at the entity level. The outcome was phenomenal. And again, we had the major firm group, we had the G400, we had our grassroots, we had our partners in the state societies. So it was a real grassroots effort that got this wonderful outcome.
And I know our AICPA Town Hall community was so involved in reaching out to their legislators. So we really appreciate that.
And it matters. It matters.
Yeah.
It made the difference.
And if you are loving all of these acronyms in the first 5 minutes, you got PTET, SALT, and SSTBs. Very quickly, SSTBs are specified service providers like accountants, lawyers, doctors, dentists, veterinarians. So a lot of the members of the profession and your clients were going to be impacted by some legislation that was in the House and that we advocated to have removed in the Senate.
And I wouldn't be shy. If you've got clients that are in those profession, you should mention the fact that we saved them a bunch of money.
Yep, agreed. So we talked briefly last week about what's next, but you're going to give us a little bit more details on taxpayer assistance.
No. Well, taxpayer assistance, but also a corrections bill. Anytime there's large legislation, and again, it doesn't matter who's in the White House or who's got the gavels, there's always a follow-up correction bill. They know when they're passing these significant bills, they make changes at the last minute. There are issues that they know they don't have their hands wrapped around. And so they fix that with a technical correction bill. Now, sometimes technical is in the eye of the beholder, but there will be legislation that will follow up to fix some of the things. And that's why it's really important that we're engaged in that process. Jan and Melanie are going to talk through implementation, but part of that one element of that is actually going back to the Hill with the things that will require statutory change. And then, reconciliation was huge. It was significant tax legislation, obviously, but we've got a follow-up act, which is the Tax Assistance and Service Act, where there's a discussion draft out. We can go to the next slide that gives, we've got some provisions in there related to the regulation of tax preparers, significant. Another one, which is huge, is the SAFE Act, which allows for a safe harbor of 125% of previous year for extensions, which would provide clarity. It's one that we hear a lot of from the membership about, trying to get a little relief during tax season. So those things are on deck. We think that there's enough bipartisan support to really give a shot at getting those done between now and the end of the year.
That's great. I know those provisions are going to be very helpful. Government funding, you've still got things to keep your eye on.
No, I know. It's not over, right? So reconciliation got done. Now they've got to figure out how they get the government funding. The appropriations bills probably will not be all complete by the end of September when government funding has to get done. And actually, I don't think the government's going to shut down. Having said that, we've seen this act before. They could take it right up to the edge. What likely will happen is there'll be an omnibus or a big package that contains the bills that have not passed. And they're going to have to negotiate how they get that done. Otherwise, we could be facing a shutdown, which impacts the IRS, Treasury, Department of Labor, those agencies that we work with. One thing to watch this week is they're actually they're debating a rescissions package in the Senate, Lisa, and that has about $9.4 billion of cuts, primarily to foreign aid and public broadcasting. The process at which that's being done only requires a simple majority, although it's questionable whether they have a simple majority, the Republicans anyway. But to get the appropriations bills done, they're going to need the 60 votes required. So if this blows up, it's not going to be a good sign for getting through the fall and keeping the government open. Again, neither side wants to shut it down, but they've got to figure out a deal at some point.
It's a good tip as we try to read the tea leaves for what comes next in the fall. Yeah.
That's right.
So that was a lightning round profession update. Mark, thank you for taking us through that. If you were not able to join us last week, Mark gave us a much deeper dive on that, and you can catch it in the replay that you'll see right here. A quick shout out to the many of you who might have joined the rebroadcast of Monday right before this one. So Mark, I'll see you back at Open Forum. Thank you. Great. And I'm going to bring in Melanie Lauritsen and Jan Lewis. I'm going to turn the gavel over to you, although I'll hold it, because you all have a lot of explaining to do as we get through these technical provisions.
Well, Lisa, I completely agree with you. And one thing that I have to say that we have to keep in mind as we go through all of this is brand new information, right? As Jan said, we're only 10 days out from when this bill became law. And so we're all going through this together. There's still a lot of questions, and we will talk about those questions out there. And there's also misinformation out there. So we will try to tackle it as we go through. Jan?
All right, so we're going to go through these. Melanie and I are going to take some turns. We'll hit some more than others, but again, we're going to be lightning round on some of the provisions. A lot of what's on this slide is the good news of this bill. It's the permanence. It's the extension of the tax rates, child credit, personal exemption, standard deduction under TCJA has now been extended permanently, so we don't have any of those sunsets. Yes, there's some little tweaks in the child tax credit. It's actually increased and a little more of it refundable, and standard deductions have been increased a little bit. But these are the ideas of what we were looking for in permanence in the individual side of this. Okay, on the next slide,
Yeah.
we're going to talk about some of the, as I say, shiny new objects in this bill. These are all provisions, whereas the preceding slide was extensions of things. They were going to extend the end of 25. Now they're 2026 and beyond. These are current new topics in this bill that had to do with some temporary things. All right, this slide is some more extensions here, the mortgage interest deduction. We'll talk about SALT in a minute, and then the casualty and theft loss deduction. One thing on SALT before we get to our detailed conversation later, that is a bigger difference than some of the others. It's not permanent. It is only for 2025 through 2020.
Right.
Through 2029. And Melanie, we've talked a lot about this, the whole $40,000. It could go down to 10,000 based on your income and the phase out. It's going to be some planning topics.
Absolutely. And that's the thing we need to all be following as to the effective dates for a lot of these. And as we go through some of these provisions, we will be telling you on the effective dates. So the SALT cap effective now.
Now,
We also have
returns.
Yep. We also have the casualty theft and loss deduction, where TCJA, they limited it to federally declared disasters through 2025. And what the act did, it extended the rule allowing the victims of qualified natural disasters to continue to claim the personal casualty losses without needing to itemize the deduction. Now, I already saw in the Q&A, there were some questions between the big win that Mark was talking about and the disaster relief and what was in the bill. The difference being is that win that Mark was talking about allows the state to declare an area of disaster, where that trigger would then allow the IRS to allow for IRS filing and payment relief. What is in this bill, HR 1, has to do with the casualty losses. So two very different pieces of it. Now, what they did include is that in this bill, or in the act, was that certain state declared disasters could also be deducted through casualty losses. So this was kind of like a foreshadowing of that win. So it was great to see that. If we move on to this next slide, we go on to the itemized miscellaneous itemized deduction. So as you guys know, TCJA disallowed those deductions for tax years 2018 through 2025. And what HR 1 that acted, it permanently suspended them. So the act also added the deduction for unreimbursed employee expenses for eligible educators to that list of itemized deductions. And I've already seen people asking, when are we going to see that list? And it just depends when the IRS has the time to put it together, and hopefully sooner rather than later. But this is effective starting in 2026. We also have charitable contributions. What the act did here was it provided a floor of 0.5% of the taxpayer's contribution base, which is essentially saying their adjusted gross income. And it also, for those that don't itemize, previously you weren't able to take any of the deductions for them. However, the act now allows non-itemizers to take and claim a charitable deduction of up to $1,000 if you're single, $2,000 if you're joint. And also, it lets the non-itemizers qualify for charitable deductions, and contributions must be in cash, and they must be a public charity, and they have to meet some other certain criteria. Again, this begins and kicks off in 2026.
And I think, Melanie, the charitable contributions will be another area that's
Yes.
a little confusing, a lot of questions about it. A lot of it is in 2026. There's also a new overall limit on itemized deductions for high-income individuals, which will also play in 2026. So
Correct.
I think we're going to get lots of confusion on what's the 0.5% and what's
Yep.
what's this, what $1,000, $2,000? Do I have to itemize? Do I not? And I think there's some planning opportunities here as well. But yeah, I think in 2026, we'll have a lot of questions on the itemized deductions, particularly for high income taxpayers.
Completely agree with you, Jan. Moving on to AMT. So TCJA, it increased the individual AMT exemption amounts, and it phased out, the exemption phase out thresholds were set to expire in 2026. But the act, it permanently extends those increased exemption amounts, but it reverts the phase outs to that of 2018 levels of 500,000 for singles, a million for married filing joint. And again, like you said, that's 2026. And then of course we have the estate and gift tax. Jan, did you want to touch base? I know it's not on this slide, but the information that we've seen on Social Security.
Yeah, and we're going to talk about on the next slide some of those temporary deductions, but I just want to make sure that I call out, and we'll probably say this a million times today. You can go on YouTube right now and you can find a million different interpretations of this bill. You can find articles and videos and webcasts. That's one thing we're used to dealing with that. And again, as CPAs, we do our homework and we get things right. What was a little confusing is the whole senior deduction, no tax on Social Security. What in the heck is this? Then you even have information coming out from the Social Security Administration. It has been so confusing. So yes, I think that this bill did not include no tax on Social Security. This bill included a new personal exemption for ages 65 and older. If you read between the lines, that publication from the Social Security didn't really say that the bill had no tax on Social Security. It talked about the number of Social Security recipients that already don't pay tax and more will not. But that is not part of this bill. Exactly right. Okay, so Lisa's already moved our slide to my favorite slide. Oh, back up. Sorry. My favorite slide is all of these, as I said, the new shiny objects, the temporary provisions. These are the ones that we're getting a lot of questions, calls. Melanie and I have talked several things about this. So let's just hit them one by one. These are all temporary provisions. They are for 2025 through 28. Which means they are effective for 2025 individual income tax returns. These are individual deductions, will likely be taken on page 1 of your individual return if you qualify. It is for the entire year. We get a lot of questions about that. Is it only from the effective date on? No, this is for the entire year of 25. So from an individual income tax standpoint, the idea of no tax on overtime, of course, has some details in it. It is really a deduction. Your W-2 is going to say the same thing. Your Schedule C is going to say the same, as far as the tips and things like that. Your gross income is the same, but you will be able to get a temporary deduction. And in the overtime case, it's $12,500 per person. It is $25,000 married filing joint. Both the tips and the overtime provisions, very interesting. You have to file joint if you're married. You cannot take any amount for married filing separate. That's going to be interesting too if you have clients that for some reason generally file separately. This overtime will be adjusted for inflation, but it will end at the end of the 28 tax year. That is an individual deduction. We're going to talk a little bit on the employer side of this in a minute. It is phased out if your single income is 150,000 or higher and married filing joint 300,000 or higher. And it's a fairly slow phase out, but it will phase out. We're going to have clients that absolutely use this. We're going to have clients that may ask about it and their income is way too high for them to even use this. But the no tax on overtime, we'll talk about the reporting requirements. It's going to be a really big deal. Tax is already being withheld from these employees on these wages. This could result in some pretty big refunds next spring because of the deduction for the overtime pay. All right, next bullet point, and then we'll stop for a second. No tax on tips. Very similar provisions as the overtime. It is a deduction. It is temporary. It is a deduction for cash tips. There's a definition for that. It includes cash and credit card and Venmo and all sorts of things like that. It is also limited, but it's limited to $25,000 per return. That's also been a lot of confusion around that. It's not $50,000 for a joint return the way we read it. It is $25,000 per return. It is also phased out, starting at $150,000 for all other taxpayers other than married, and $300,000, and you must file a joint return for married filing joint. We'll have some adjustments for inflation, and again, it is temporary only for tax years 25 through 28. Both of these, Melanie, remind me all of the different questions we have on this, but it has to do with the effective date. Yes, it's for the full year. Has to do with, oh, do I get to take this even if I don't itemize? Yes, you get to take it regardless. If I am self-employed, how does this tips work? If I'm an employee and I work overtime, is it all overtime or just the premium? What we're understanding right now is that it is just the premium. So if you get time and a half for overtime, it is just that 50%, the premium amount that you're able to take the deduction for. On the tips, yes, if you're a self-employed worker that files a Schedule C, if a portion of your income comes from tips, that's perfectly fine too. You'll get that deduction. Does not impact Social Security and Medicare tax. I'm trying to think of all the other questions we're getting on this. A lot of what I'm hearing is from an employer, is the reporting part of it. I think that's going to be the headache. Yeah.
And that's what I'm seeing. A lot of times people are like, well, they're asking about their W-2s, right? But then how does the employer break this out? How do they account for it? And again, I can't stress enough, that is part of the guidance that we're waiting for and that we very much need from the IRS. And we will touch base on that down the road.
Right. And if I remember correctly, in the bill, it specifically says Treasury should issue within the next, I think, 90 days.
90 days after July 4th. Yep.
Yes. And within 90 days, they're supposed to tell us what types of occupations are customarily receiving tips according to the Treasury.
Right.
That'll be our first part of guidance. Maybe, hopefully it won't be our last, but we will get that. And then I think just the whole idea of how am I going to accumulate this? There's also in the bill statements to the effect that for 2025, whatever is reasonably estimatable for the tips and the overtime. That is going to be really complicated how that's going to be done, because we don't really expect, as you said, the withholding, the W-4 forms, all of that to really be revised until 2026. There's not a box on the W-2 for this. So how employers report, how self-employed people break out their tips is going to be challenging, and we're going to need a little guidance.
And I'll say one last thing, and then we'll move on to the auto loans and the exemption. Another thing that people are saying, well, can I shift my employee's salary? You know, like this much is their base and this much tips. But it's also the way the law is written is what is ordinary right now, like what it was before the law. So it's not like you can go forward and just readjust people's pay structure.
Exactly. Clients who ask about this, if they start asking about whether they can change an employee to overtime or salary, that phone call is the same that it was before this, which is you need to call your employment lawyer if you've got questions as to whether somebody really is exempt from overtime or not. That's exactly right. Okay. Auto loan interest may not affect maybe as many people as the overtime or tips. Again, a temporary provision. It is a deduction. Again, we think it's going to be on page 1 of your return, not an itemized deduction. Even if you claim standard deduction, you should be able to deduct this. There is a phase out, $100,000, a little lower phase out, $100,000, but $200,000 for married filing joint. You deduct your interest up to a maximum amount of interest of $10,000. This is actually not adjusted for inflation. And this, the vehicle has to be a new vehicle purchased between 2025 and 2028. And that vehicle has to have final assembly in the US. So maybe if you've bought a car the first 6 months of this year, this applies to you. Otherwise, we're going to see this from 2025 through 2028. And there's even some provisions about, will there be a new 1098, how to report this? Will banks and financing companies have to report this interest? Again, I'm not sure that's going to happen for 2025, but it certainly will for 2026.
And the cars have requirements too, like they have to be 14,000 pounds or under 14,000 pounds. I mean, there's other requirements. It has to be, like the vehicle final assembly has to be in the US. So there's other requirements. Again, the nitty gritty.
One more thing before we move on to the business tax provisions. The last bullet point on that slide went back to something we already talked about, which was the senior deduction. I think there's one thing that has the most confusion about is this. I was on a tax Twitter conversation this weekend about this very thing. It's $6,000 exemption. It's not an add to your standard deduction. You can still take this plus your standard deduction. $6,000 for each taxpayer that is 65 or older by the end of the year. So that means if you're a married couple, you have $12,000 deduction. It is phased out. Again, you see that 150 married filing joint, 75 for all others. The way the phase out is, it's like 6% of the amount gets phased out. So there's already questions about if I'm married and I have two people, is that 12,000? So is my phase out range 200,000 or is it still the 100,000? Does each taxpayer stand on their own? We'll need some guidance on it. But this is essentially the replacement for Congress couldn't just have no tax on Social Security. That would not have passed the Byrd rule that Mark Peterson tells us about. But it is a way to give an additional deduction. It does not matter whether you're getting Social Security benefits or not. Doesn't matter if you're getting disability, if you've put it off till age 70. None of that matters. It is age dependent only. Right. Last thing I'm going to say about senior deduction. Okay, Melanie, you take it.
Okay, so we're going to move on to the business tax provisions here. And so let's go ahead and jump in with bonus depreciation. This one's pretty cut and dry. With TCJA, the applicable rate for bonus depreciation was being phased down to 0 over multiple years, as you guys know. And the Act actually permanently sets the bonus depreciation to 100% bonus depreciation. And it is effective starting January 19th, 2025. So that's the one with a one-off date of January 19th. We also see Section 179, which Section 179 allows immediate expensing deductions for certain business properties, and there is an annual limit of $1 million for it, and that limit is also phased down once a property is placed in service during the years that exceed $2.5 million. So what the Act did, it increased the expensing limit to $2.5 million and then increased the phase down threshold to $400 million. And the provision is effective for properties placed in service in tax years beginning now in 2025. Section 163J. So currently, Section 163J limits the amount of interest a business can deduct with certain exceptions and calculations, of which goes into the earning before interest, taxes, and amortization, so EBITDA. And what the Act does, it returns the EBITDA calculation into it. So what it does essentially is it enables companies to be able to deduct more interest expenses, and it also reduces the carry forwards. However, the change also excluded subpart F and the GILTI, which is the global intangible low taxed income inclusions. So it may not be so beneficial for those types of companies. Now, the provisions for this, it is effective beginning in 2026.
And that's interesting. On that slide, you can see that the bonus depreciation and the 179 are absolutely things that for tax returns, we're going to prepare for 2025. In reality, folks that are paying their quarterly estimates, for third and fourth quarter, and if they've added a lot of equipment already this year, we need to, revise those. Whereas the 163J is effective for 26. So again, just as you said at the beginning, we're really going to have to watch these effective dates, and when they're going to, try to prioritize when they're going to really impact our clients and businesses.
Yeah. Next
All
slide.
right. Next slide. Okay, I'm going to hit these two. Family medical leave credit. Again, it enhances that credit. It permanently extends it. I always think it's interesting when we see tax bills and when we read about certain things being enhanced, modified, extended. I always think, I always forget about that credit. So there are a lot of things that maybe we just need to go back and make sure we understand. There is a credit available for family and medical leave. Again, those are effective starting in 2026. The R&D, we have talked about this till we're blue in the face for how many years now? Since 2021, I believe. Let's see if we can unpack what's in the bill. And Melanie, help me if I'm forgetting any key piece of this. Sure. The most important is for tax years starting in 2025, R&E expenses that are domestic R&E expenses are now able to be deducted in full. Correct. We're back to pre-TCJA. Now, foreign R&D expenses still have to be amortized over 15 years. But this is different. If you look on the left, we have been dealing with since basically 22 returns and forward, we have had to capitalize and amortize our domestic expenses. All right, so now we get to expense them starting in 2025. Great. Again, this is effective for this year. We need to relook at what we've done, what we've planned, what our operations are going to be. But what about, we've got capitalized expenses for 22, 23. We've already filed 2024 returns that we have capitalized and amortized. What about those unamortized expenses? And this is where the tax nerds, all of us, just get in the weeds of what happens with this. And quite honestly, I do think we need some guidance on some of this. But in general, any taxpayer, regardless of size of revenue, will be able to deduct any unamortized R&E expenses either on the 2025 tax return, or they can split it between 25 and 26. But that's an election that
Right.
that taxpayer makes, right? Okay.
Yes.
A small business, which is defined as a business with less than 31 million of gross receipts, gets even more options. They can certainly do those options, right? But they've specifically been carved out in the bill and said, you know what, these small businesses, pretend like TCJA limits never happened, and that basically expensing is okay for you guys, basically for 22, 23, 24, and on. That's where some of the confusion gets in and the regulations comes in, because the bill specifically says these taxpayers can go back and amend 22, 23, 24 returns and deduct them, get immediate money back. Hopefully, we don't know how long it'll take to process those amended returns. You need to think about it. But they could actually file to get their refunds and don't have to split it. They certainly can get it all in 25, 25, 26. This is where, Melanie, I've gotten some questions from taxpayers and businesses trying to figure out what's best for them. If they're in that small category, maybe I haven't even filed my 24 return yet. I think we're still stuck with the 24 rules. But, you know, once we get guidance on this, because this election has to be made within a year on the amended returns, I think that will clarify some of that for us.
So what I'll say is all these questions, and you and I have been talking about these issues that we're talking about right now, and the fact that we need clarity. So we fortunately have amazing volunteers, an amazing team behind us that helps us support all this. And they actually had a conversation with the IRS this morning. And literally as town hall was starting, I got a text coming in where they brought all these questions that you're asking to the attention of the IRS, and they are very sympathetic for the small businesses. They're very clear on the large businesses and that they don't, nothing for dispute there. But for the small businesses, they recognize that guidance is needed. They did not indicate when that guidance would be coming out, but at least they are aware of some of the questions that we have and a lot of our members have too. So again, guidance is still needed.
Right. And what if you're a what if you're a partnership and you're a BBA partnership? You can't file amended returns. So we need specifics on how this would happen.
Yes.
Again, if you don't get that by September 15th, which I'm likely we would not.
What do you do?
Again, my opinion is 24, you just, continue to do what you do, then we'll get clarity. I think, again, going back to how you communicate with clients and with your business owners is we don't know everything. We need to immerse ourselves to understand the law, but then the next step is how do we communicate that and how does that fit into that particular taxpayer? Okay, keep moving.
So we're going to move on to this next slide.
Speaking of pass-throughs, go right ahead.
I know, pass-through entities and the provisions for them. So Section 199 Cap A. So currently, Section 199 Cap A allows for the deduction of 20% for QBIs, qualified business incomes, and you guys know this already. And the QBI deduction has two limitations, one of them based on W-2 wages, and the other one is for the SSTVs, which Lisa went over earlier, the specified service trader business. Now, what the act did, it did three things, okay? It made the deduction permanent. So that's one. Two, it retained the 20% rate. And three, it increased that QBI deduction limitation phase-in range by $50,000 for those that are married, filing joint, and $25,000 for all others. The reason I just explained it is because there was a lot of confusion between the House bill that came out, the Senate initial bill, the Senate final bill, and then the final law. And I still get a lot of questions like, what is the rate? Nothing has changed, and these provisions are still consistent aside from those three things. It made it permanent, kept it at 20%, and the phase-in range changed for that. We also have the pass-through entity SALT deduction. And we've talked about this earlier. Mark was talking about huge win for the profession, for us. And so what it comes down to is currently, again, there's a lot of confusion. So let me express what we have currently. Taxpayers are subject to the 10,000 SALT deduction limit. And as most of you know, that the states and their localities, they came forward and they enacted legislation that allows them to be able to take the SALT deduction at the entity level. Now, again, the House and the Senate, they introduced various provisions, and there's still a lot of confusion out there. But because of that huge collaboration win that we had, the final bill keeps things as it is. So the current law, as we know it, will continue and has been in effect. There are no changes to the final law.
Am I saying it correctly, Melanie, that there was actually no wording in this bill at all
100% right.
anything
Yes.
to do with the PTE deduction or Notice
Correct.
2020-75 or anything that, but I think you're right. We were all so worked up about the provisions in the House bill that, again, has caused some miscommunication. I do think with the 40,000 SALT cap, possibly some smaller businesses, depending on your state tax rate, depending on, maybe you don't want to use your PTET anymore. But the main takeaway here is you can and should if it's the right thing for that business.
Correct. And on this next slide, we're going to talk about that misinformation because there is a lot of confusion around this. And we saw some blogs out there, and we even saw an article about the timing with the pass-through entity SALT deduction, what was going on with it. So I had to bring up, so the House version, it introduced new terms such as specified tax, accepted tax, which this notice essentially said that the SALT deductions at the state, through the pass-through entities were allowable, and what the states are doing is correct. But this notice didn't include the definitions for those terms. So some people started to argue that a new notice needed to come forward. The other piece of it was the timing and the date. So some people were saying that it expired, which it did not expire because it has the November 2020 date in there. But what it really, and if that were true, by the way, this notice would have been valid for 1 day and no more than 1 day. So this is still valid. It is very common that this is still valid. There is still a lot of guidance we are asking questions for, but that's been a long-standing situation through the years.
Since November 9th of 2020.
Absolutely. So
Yeah.
There's a lot of confusion. Things are as they are. And so I definitely wanted to give that one a call out. Okay, on to the next slide, Jan.
Okay. All right. Key business provisions really quickly here because we're going to run short of time if we cover everything. If you're a C corporation, a couple of things here. The 1202 small business stock gain exclusion. Maybe it's worth looking at because now it has been extended. The amount, the corporate level of assets is 75 million rather than 50 million. And there's now actually an exclusion of gain for if you only held your stock for 3 years instead of 5 years. It may be worth looking if you're a C corporation and have a client looking to sell. Corporate charitable deduction, again, for C corporations. Very odd that we now don't just have a ceiling like we've been living with of 10% of income. We now have a floor also, kind of like we talked about that on the individual side, but we now have a floor. The first 1% of taxable income is not deductible at all. So those are some new provisions. Again, nothing earth shattering on C corporations, but these are a couple of those provisions.
Okay, so we're going to shift over into international provisions. So first of all, I do want to acknowledge that there were changes for the international area, but we aren't going to cover it deeply. And the two provisions that you see here, those two alone are complicated. They each can be their own session, and we're talking hours of digging in for them. But in a nutshell, right, what the act did, it renamed the GILTI and FDII provisions to net controlled foreign corporation and tested income, so NCTI, and foreign derived deduction eligible income, FDDEI, respectively. So the act, it repeals the TCJA rate changes for not only FDII and GILTI, but also BEAT that we're going to change in 2026. And it proposes new rates as a permanent starting point starting in 2026. Now, for GILTI, the act limits the deductions of a U.S. shareholder, which applicable to the income in the GILTI category for purposes of determining the foreign tax credit. And that limitation only for Section 250, by the way, deduction relating to GILTI. So all the other expenses would remain in the U.S. basket. And for FDII, they did something similar of what was only directly allocable deductions. So again, like I said, very complicated stuff. We don't have a lot of time to pass through it. And on this next slide, it goes into the B and also section 954. C6. So for BEAT, the Act increases the rate to 10.5% of modified taxable income beginning in 2026. And so it would maintain the current law treatment for the research credit and certain other credits in the BEAT computation on a permanent basis. So again, everything related to BEAT and all the modifications around it, those are beginning in 2026. I'm just making sure we're on the right slide here. We are. Okay. So moving on to the last slide in international, the one thing that I do want to touch base on is on the repeal of election for the 1 month deferral for a year, and a specified corporation using a 1 month deferral year would be required to change to use it to majority U.S. shareholder year. So just making you guys aware of that. And with that, Jan, I'm turning it over to you, and we're going to touch on one of the topics that we've talked a lot about.
Yeah, and up until now we've talked about individual and corporate income tax provisions, new income tax deductions, extensions of rate, extensions of standard deduction. All those things are going to affect income tax returns for all types of entities. There are a few topics here that aren't necessarily income tax issues. They may be payroll or other type taxpayers, but we just want to mention that and in the next couple of slides. First of all, employee retention credit, payroll tax credit. We're all very weary of ERC. I think I can speak for thousands of town hall attendees, but we have to keep up with this. We have to understand what's current law, what's happening with the IRS, and what to tell clients about it. I think the AICPA has been very clear on town halls and tax division meetings. Be very careful. We had a bill back a year or two ago that said they were going to have this January 31st cutoff. It never got passed, but we have all, I think, been very clear with our clients and with businesses that there's a good chance that January 31st, 24 cutoff was going to be there. And sure enough, it is. It is in this bill. IRS will not process any claims filed after January 31st, 2024. And of course, this is really just for quarter three and a very few small businesses that could even file for quarter four of 21 because the statute's already closed on 2020. This bill does provide a little tougher sanctions on promoters and more penalties. I think that's probably a welcome change if there's some fraudulent credits out there. And it does extend the statute of limitations for 6 years, again, just for these quarter three and quarter four of 2021. That's for both the IRS and the taxpayer. The IRS can come back and look at these claims, and the taxpayers, if something is disallowed, they still have an open statute that they can take deductions. We know that there are still questions on ERC. We know that there are still some valid claims out there that were filed before January 31st, 24 that still haven't been paid. We know that there are some fraudulent claims and some promoters that probably shouldn't have been hawking the credits. We know all of that. I think we just, Chris Esposito, and she's a director in our tax policy advocacy, and Melanie's team, they have been great at telling us, watch out for this. We're at the mercy of the IRS for processing, and we've been telling our clients to be patient. I don't really think that message changes that much based on this bill. Anything else on ERC, Melanie, or can we?
Nope, that's it. Let's a quick shout out to the 529 plans that it allowed our, to be able to our profession sitting fees to take the CPA exam and preparation fees are included in that. And there was also an increase also in what you could contribute for those in kindergarten through 12th grade. And we're also going to just go ahead and jump on the next set of slides. Yep. Moving on to the Form 1099s. So Form 1099K, again, was a big issue for our profession in order to try to provide some reporting relief for people. It's not a filing money relief, but it is a reporting relief. And what essentially does it repealed it back to the American Rescue Plan Act, which brought up the increase to 20,000 and also 200 transactions. And of course, we saw increases with the other 1099 pieces.
And I think those are very welcome. The NEC and the miscellaneous will be very welcome. That $600 limit has not been indexed for years. And now, but again, that's for 2026, not for current year. We'll still have to do those 1099s for 2025, but then it goes to $2,000.
Yep. And then the other thing that I'm going to just gloss over the energy credits because the energy credits, there was a lot of things that happened there, but essentially the act, or HR1 as you want to call it, it terminated a wide range of Inflation Reduction Act clean energy credits. It also phased out the advanced manufacturing product production credits, and it also restricted a handful of the credits for prohibited foreign entities. So just that's a bunch of awareness that I wanted to cover on that. And then let's just go ahead and jump to, and you'll see those things on the energy credits, so it's sort of listed out on the slides, but let's go ahead and jump into beyond the law and implementation.
Melanie, I think this is where we need your help and making sure we know what are we reading, what are we getting, and what weight does it have. So tell us that.
Yeah. Okay. So we have to understand that both, we have all these questions going on, and this is exactly where IRS and Treasury step in, right? And this is where we're going to see a lot of information. And the IRS has a variety of avenues to provide and issue guidance. And this is what you see listed here. So the easiest and generally the first method consists of the various forms that are non-authoritative guidance, or non-binding, as I call it sometimes. And that has to do like the IRS website, their announcements, their FAQs. But you can't really fully rely on them, meaning they're not authoritative. However, they are a support for us. And we see the IRS do this kind of thing when they have to get information out quickly and timely, especially for those retroactive provisions. So we do expect to see FAQs. But keep in mind, we also saw that happening with the partnership audits regimes, and they were issuing an FAQ in the middle of filing season, right before the deadline. And so depending on what date you filed a partnership return, you were filing different things and reporting different pieces of information. So again, it's not authoritative, it is a support, and it is guidance. From there, we have notices, which the IRS again can do fairly quickly for us. And this was done, and you saw quite a bit of it after TCJAs, and they really do become the cornerstone of most recent legislation. And that becomes what we're waiting on before we see proposed regulations or final regulations. Now, the notices generally include a provision for a proposed regulation. So those, you can rely on them a little bit more. And again, that's because there's a lot of coordination happening between the IRS, Treasury, and of course, Chief Counsel in order to get this information for you. And then we, of course, will see the proposed regulations and final regulations. And when final regulations come out, that's when you have the ability to be able to provide comments and questions and say certain things are outstanding. And of course, final regulations, those are completely authoritative and you can rely on them absolutely with those. So again, that's a lot of things that are coming at once, but even throughout this whole process, and we've mentioned this, then you start to see the form changes that come out. And form changes historically for the IRS, those are a big lift, right? They take about a year for the IRS to be able to do those form changes. So that again is something that they're doing. And of course, as you can tell, all this type of information that's coming at us, it really does require all hands on deck for the IRS and Treasury. But to throw a wrench into everything, because of course I have to mention it, this is going to be the first real test of the Supreme Court Loper Bright decision that came in regarding the Chevron deference. And that's what we're waiting to see, how exactly the IRS is going to play out with their regulation and how all of this will come out and pan out. Right. So again, this is a lot, and we're going to see a lot of questions with that.
And this just talks about how, look, as AICPA, as a member organization, that's what we're doing. We've gotten past the bill now, gotten into law. We've got questions. We always identify these issues. We've got tons of volunteers. We've got staff like Melanie and her team. That's the job here, and all voices are heard. It doesn't matter if you're a sole practitioner or if you're a Big Four firm. All of these positions, we comment on things, we comment on regulations, we ask for guidance. As Melanie already mentioned, we've already talked to them even today with a meeting. So we're going to try that. It's going to be a challenging time for the IRS. So hopefully our voice will be heard.
Right. And it's just that is our process there. We figure out what those questions are and we get answers from the IRS. And so that's also advocacy work. So again, it goes from legislative to regulatory, but it's all advocacy work. Okay. I'm going to quickly cover this next slide because it really is the elephant. Well, no, actually, this next slide has to do with the National Tax Conference. So again, we've been telling you we're barely touching on a lot of these provisions, but the National Tax Conference is an opportunity where it will take deep dives into different specific pieces. And by then, we should have more regulation and information. And what is new for this year, we are offering a pass the baton. So if you are registered, you can bring in a first-time attendee for 50% off. So I have to plug that because that is where you will get more reliable, deeper information coming in with regards to this bill. Okay, so let's really talk about the elephant in the room here, because as you can see, the IRS has a lot to do for us. And a lot of people are asking, what about all the risks? And you've seen the report that just came out, the mid-year report from Aaron Collins, of where a quarter of the organization was, they reduced the workforce for them. However, I can't stress enough that it is in the administration's, Congress's, and the IRS's interest to be able to implement this law and implement it correctly. And this is something that they are pushing and looking to do. And I know they've already started their conversations with it. But again, from our perspective, we are monitoring this because we need to have answers to the questions we ask. So Jan, Lisa, I turn it over to you guys.
Yeah, I know Lisa's coming back on. I just want to also say that National Tax Conference is a great deep dive. Once a year in DC, you really learn a lot about whatever's going on. And then also, some planning opportunities and things you can do for year end. And also, there will be more town halls. There will be Washington tax briefs. There will be CPE on this throughout the next 6 months. Thank goodness the bill passed in July. Otherwise, I'm not sure we would have survived.
Thank you. Melanie, go take a break, get a drink of water. Water. And we'll bring you back at open forum. We've got about 500 or so tax questions, and they're still coming in. So let's see what we got. Jan, we've got just a couple of minutes, but I think this is really an important topic around how are you engaging with your clients now? We had a couple of practitioners join us last Thursday, and I just wanted to get your thoughts. Are your clients already reaching out to you? And where are you on trying to answer questions?
Yes, they're already reaching out. They're calling, emailing, texting, and sometimes they know what they're asking about, maybe something they read or heard. Sometimes they don't even know what they're asking about, but it's just a broad question of what does this mean for me? And they're hoping that we understand their situation enough that we can bring up, oh, you're in the construction business, let's talk about bonus depreciation. Oh, the estate exemption has been permanent at 15 million. That allows you to do X. Oh, you have a lot of employees. Okay, this is going to be an issue with you with tips and overtime. This is what you need to say to those employees who are peppering you with questions. And then just thinking about year-end planning and third and fourth quarter estimates. Are things that we're doing, if you're R&E, should that change anything that you're paying in? And the other question that's not on this slide is, what about state impacts of all of this? We've talked all about federal changes, but how do if I elect something, if I do a certain thing for my R&E for federal, what does that mean for my state? If I have to report, if I get a deduction for overtime and tips for federal, how does that affect my state? Bonus 179, all of those kind of things. So I even had something on there about Roth conversions and some of the crazy math we're seeing about, well, if you be careful of things that you do that increase your adjusted gross income, because then you might phase yourself out of your SALT limit, and just all sorts of things. And it really varies by taxpayer. So we have to kind of have our cheat sheets down as to individual business provisions, pass-through entities. And if someone calls and asks about a Trump account, I just tell them I'll talk about next year, because again, that's for 2026. Let me focus and try to prioritize on things that really matter for 2025.
Jan, seriously, it's almost like you are a mind reader, or you're really in tune with our town hall audience, because we've gotten lots of questions about the Trump account. So thank you for pointing out that they are effective next year, and so we'll have plenty of time to talk about
That's
that.
right. And we still have a
So-
lot of guidance to get on that. Absolutely.
Exactly. And I think that need for guidance plays into the mantra that we're probably going to have to read at every town hall for the next few months, which is we're all going to need patience. I'm not kidding. We've got over 500 tax-related questions now in the Q&A, and a lot of them, to the points that Melanie and Jan made earlier, we're not going to be able to give you answers on yet because we're going to need that IRS implementation.
But those questions help us. It helps our
Oh,
committees,
yeah.
our volunteers, our staff. It helps the town hall know what is top of mind for practitioners.
Absolutely. That's a great point, Jan. Thank you for saying that, because we've been using your town hall Q&A since the beginning, over 5 years ago, for insight into where we need to be digging. So thank you to everyone in the community for your questions. They're really helpful. Let's move on into open forum. If Melanie's had a chance to get a drink of water, and Mark, welcome back. So we're getting a lot of questions about a ton of different topics. R&E and whether or not you can go ahead and take the deduction in 2024. Jan, I think you're reading it as what? I'm not going to put words in your mouth.
Yeah, it looks to me like, and again, I'm so glad Melanie's team has already had a meeting on this, and we'll get some information about this, but it looks to me like the law says that immediate expensing happens in 2025 for all taxpayers. And even though it's retroactive to 2022 for small business taxpayers, it refers to the need for amending 24 returns, and it talks about making elections and filing for an automatic change in accounting method. So can all of those really be done on a 24 return? That's the confusing part to me. And I think that's why we really need, but I do agree, Melanie. I think Treasury is very sensitive to small business. They may come back and say, fine. Again, it's July. We have 2 months until that extended deadline. So I think we give it a few weeks to see what happens.
That's a great point there. We're also getting lots and lots of questions about that $6,000 senior deduction. If a taxpayer dies during the year, is it prorated, or do they get that straight $6,000 deduction, and how all of that works? So we'll wait to see how some of those things play out. Lots of questions about just so many different topics. So Mark or Melanie, anything you want to add before we go into our closing slides?
No, the only thing I wanted to mention is that Melanie raised Loper Bright and the Chevron deference, and this is the first big bill, as she mentioned. It really puts pressure on that technical correction bill, because what it does is if statutes are ambiguous, that's where they take away the deference from the agencies, from the IRS and Treasury. So the way to solve that is through statute, which means that correction bill. So this is a whole new dynamic for this implementation of this bill that we're going to have to watch closely.
And thank you. We were getting some questions about the Loper Bright decision and how that would impact us. So that's a great clarification. Melanie, anything on your part? You've been looking at the Q&A.
I have been looking at that Q&A, Lisa. I saw quite a few questions come in with regards to the ERC and the statute of limitations, the 6-year statute of limitations. And quite frankly, the way that we're looking at it and our understanding of it is that when the IRS comes back and they tell you to amend something, then you have that period to amend that return. Beyond that, a lot of the other statutes of limitations have expired.
Okay. Great. All right. With that, I'll wrap it up for us today. In case you didn't figure this out already, this new law is very complex, and it is not a step towards simplification. So you are going to need to be familiar with the basics. I think the slides that Melanie and Jan gave you are an incredible resource. So make sure that you download the slides from today. And I also wanted to remind you that we had a good conversation last week about how to use some tax research tools. CPA.com has created a special provider relationship with BlueJay, and you get a significant discount on this particular AR research tool. So just wanted to make sure that you knew that that was available to you. We have gotten tons of questions about what is next from a training standpoint. If you want to continue on this journey with us, I certainly hope you do. We'll have tons of conversations on upcoming AICPA town halls. And you can also catch up a little bit with this podcast that talks about crossover planning between income tax and personal financial planning. And that includes a lot of estate tax considerations as well. So you've got a great podcast there. We've got the Summer Tax Rewind that is very soon, might be tomorrow. And then we've got tons of resources for you in our AICPA Tax Section Resource Center. I love these charts. I think they're going to be really helpful for you as you continue to get those questions from your clients and as you're looking at what you need to be upskilling all of your team on as we get further into the fall. But again, a lot of patience needed over the next few months as the IRS works toward implementation. A quick plug for our tax section. If you're not a member, I'd highly recommend that you consider it. You get a lot of great resources. And then my final ask of you to prepare to participate in the benchmarking survey that closes this week on July 18th. Also, always a reminder about the great way that you have to access the resources. If you're having trouble downloading the slides from the On24 platform, you can go get them through this cpa.com/townhall website. Just use your AICPA member login, and you'll be able to get those slides. Upcoming town halls where you'll get all the latest information and the context that we can provide for your calendars, and you'll be auto-enrolled for these if you're an AICPA member. With that, I want to thank you very, very much for joining in for this quickly scheduled AICPA Town Hall today. And thank you very much for your comments and questions. Have a good day.
Thank you for your participation. You can also subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and find resources at cpa.com/townhall. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.